All right. Give me 1 second here. Set this up. Sorry, I'm doing it my side. Hey, Chris, what's going on, man?
Good morning.
Hey, Merry post-Christmas to you.
Merry post-Christmas.
How did everything go?
Everything's great, other than Santa delivering some holiday sniffles to me, which I just kind of caught a little bit yesterday, but all good.
Comes with the season, I guess.
Yeah, exactly. So anyway, all good. All happy Friday. One final day before we then have some more holiday disruptive trading next week. All-time highs. Congrats on everyone just reining in the new year. And hopefully the Santa rally will continue to go a little bit. We talked about that 6950, 7,000 level on SPX. Nice little milestone to potentially celebrate here maybe in the next couple of weeks as we get into January. Just want to take a look at everything quickly this morning, Nick. Plus or minus on the day is only like 18, 19 points. So the markets are expecting some pretty quiet action. I would say, if anything, maybe just some more drift to the upside. 50 is possible, 6950, 7,000 maybe into next week. I did want to price out something as far as maybe defense plays or hedging the portfolio for next year. Do you like anything in particular? Or you just want to be rotating, diversifying?
Yeah, I mean, so I still think that the playbook for me, generally speaking, is smaller caps and just moving away from just being super concentrated in the Mag 7.
Right.
For that it's challenging, right? Because you have the circumstance where what is actually on sale at the broad level, and the answer is only really crypto. So I mean, it's like, and that's kind of dangerous, right? Because that's on sale, but it could be much more sale. So I think look at precious metals. I mean, they're the only thing I think right now that is like incredibly moving. Like everything's been pretty quiet, but there goes precious metals. Silver is just ridiculous. It hit $75 an ounce.
Unreal. Yeah.
So I mean, this is just a one-directional move that is pretty incredible. So, as you look to the new year, the question is, for me to figure out, like, where do I want to be that's away from Mag 7? You have to start asking yourself, okay, well, what's your thoughts on the dollar? Because if you think you're going to get a weaker dollar, maybe the answer is, maybe interest rate cuts. But if the economies of the world hold up okay, maybe like Russell and some international stocks could do well. That would be sort of a rotation to an extent. Or this past year we've had a good performance from non-US companies or non-US ETFs, etc. But is that going to continue? So I think that the bigger question is how allocated do you remain right now is a big one for me. It's like, okay, if you're spread out across all these things, like do you want to be 100% invested? Do you want to be 50% invested, 75% invested? I feel like that's the question, is how do you feel about where these markets are as a whole? Because if you get that right, obviously that's the big one, is if you are sort of cash heavy into 4 or 5% pullback or 10% pullback into the new year, that could be a place to kind of reset and take a look at where you want to be.
Right. As far as something I was going to do today, since VIX is relatively low, I mean, we hit some fresh 2025 lows on the VIX. This would have been on Tuesday or I guess Wednesday was our half day of trading for Christmas Eve, $13.40 VIX. I think what I want to look at, just to make sure it's cheap, but also if we are truly going to get this, potential 10-20% tail one way or the other, I'm looking at something really, really inexpensive. This may not be the actual trade itself as far as pricing, but this is what I'm kind of looking at is if I went out maybe to the end of 2026. Let me go, let's just get some numbers here. So SPX, and I said, you know what, Nick, I think that this, the fourth turning, the valuations, blah, 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 all these things are going to lead to terrible outcomes. Like if I'm hedging my portfolio, usually that is truly played like an insurance. I'm going to pay somewhere between like $250 to $500. That's usually my max is like $1,000 if the asymmetry is a monster, like 30 to 1, 40 to 1. So if I did something like this, I think if I go 20% from current price, that's going to be like 5,700 or so. 50, I guess just under 5,900 since we had all-time high. So 15%, let's go 20%. This would be a little bit cheaper then. So from 20% on the nose is around 55, we'll say 55.50. All right. So if I go out on SPX, and I could trade this on futures, I could trade this on SPY, I can trade, there's a lot of ways to make this like pretty cost effective. So SPX might be a little pricey. SPY could be pretty cheap. Let's go let's go January 2027. There's a 12-month hedge there. Right around 550, I suppose. So if I did a 550 by 545, so for 52 cents, I can get up to like $5 risking 52 cents. So it's like a 9 to 1, 448 over 52. So it's about 8.6 to 1. Not an awesome hedge, but this one's a little bit, this is at 8.6. This would be 898 by 102. There's an 8.8. So, if you want like an 8 to 1 hedge or 9 to 1 hedge, that's a pretty inexpensive way to do it. Doesn't have to be super, super pricey. If I did this for, like I said, no more than typically like $500 on a hedge. So there's a $500 risk I can make up to just under $5,000. There's better ways to play it. That's a year out. I think a lot of that is time premium baked into it. I'd like to see that, 5 or 10 wide. If it was a 10 wide, I'd like to pay, I don't know, 30 cents for it, 40 cents for it, or do futures. So that's just what I've been kicking around since I know the VIX is low, having some like set it and forget it type protection, because if we're going to have a trade that's going to close, 10% lower, 15% lower, 20% lower, I'd like to have something out there that is running where I think the tricky thing for 2026 would be if we're hitting highs, but then we have 5 to 10% correction, and then we're coming back to hitting highs, and then another correction, and like that is the type of indecision that doesn't really break the market, but it doesn't make trading any easier for traders to look for momentum and look for trends. And I don't. Again, we're kind of having the same conversation. Like I'm quite cautious of where we're going to just throw positions in for 2026.
Sure. And I think like if you're talking about, the one that's down, Bitcoin being down is to me is still a signal. I think last time we spoke, I was harping on the concerns that I have about, the carry trade potentially becoming a problem in 2026.
Yep.
We've seen little like spurts of this where you get this kind of signal from the Bank of Japan that they want to hike rates. And the global market does not like that. When they hear that, they're like, oh, hiking rates from Japan, which has been a source of low borrowing funds for the world, has been a concerning, red flag. And I still can't help but kind of look at gold and silver and say, this is not, you can't just like be seeing these kinds of moves and it just mean absolutely nothing.
Sure.
The market is definitely worried about something.
Sure.
And so I think, I think the idea of being a bit hedged, diversified, or just maybe not super all in on AI tech stocks,
right.
I think is a prudent thing to do, because again, if you get something where, the Bank of Japan starts hiking rates quickly or something, it's valuations. It's kind of always a concern. If you have stocks very, very expensive, something coming along and knocking them down can make it very much worse if the valuations are very high to start with. So my thought process on it is, I don't know what that's going to be. I generally lean bullish going into 2026. Like I think the market can continue. I think If it's going to continue, though, I think that there's a better chance that you get some sort of rotation, some sort of like the rest of the market performing a little bit better, holding up well. So yeah, I mean, I feel that the risk reward for me personally looks a little bit more attractive in tech stocks. I still, of course, want to hold and own some of the better tech stocks that I like, but I just think that, okay, you get a couple scenarios. You could get the scenario where the market gets freaked out about something, and then AI tech stocks will get hit very, very hard. Or you have the market kind of continue, in which I think if it's going to continue, this is the fourth year of a bull market. I think it probably wants to rotate. So I just think that most scenarios for me, I think I see a better case for, still having some tech exposure, but not being, leveraged or all in on that trade. And then also Bitcoin being just not performing very well here. To me, as a barometer, I think you have to kind of look at Bitcoin and gold and say, what is that telling you about the market's kind of like risk appetite? Perhaps it is demanding a little bit more in 2026.
I'm actually looking up to see, has RSP ever outperformed SPY? So RSP started trading back in 2003. SPY has been around since the 90s. So just going from 2003 to now, I actually want to find out if there's been an outperformance in RSP, and if so, how significant. This has been argued like this is a great place to hide out if you're, overweight Mag 7. It's hard to hate on Mag 7. I think that what the world needs is Mag 7 to still be providing good earnings and providing good stability. I just think the growth side is probably not as amazing. I think they're super strong companies, but AI is going to make everything a bit cheaper and a bit hopefully more competitive, and that is kind of playing king of the mountain with everyone in large cap tech, because we talked about this before. This could be like kind of leapfrogging from one tech company to the next of who's leading. But it is kind of crazy to think like Nvidia is trading at 30 plus times sales, not like earnings. Like earnings, I mean, we've seen Tesla's valuations like 200 times earnings, but times sales. I mean that is pretty high, and that's the number one company in the world. That's the number one stock in the world. That's the biggest company in the world. Like we've hit $5 trillion a couple times. There's a lot riding on that, man, and the concentration, like you said, it's really, really high. I don't really know what to do with that outside of, hey, you know what? The world loves Mag 7 and the world loves US tech, and it's still steady and stable. Maybe it's not 20-30% upside for 2026, but even if it's a 5%, 10%, it's like it's enough to keep this added support and buoyancy to the market while other things can rotate in. Why do you think that financials could benefit? Like that's one thing I'm reading about a lot is financials are expected to do very, very well in this next rotation. And why do you think that would be? And if so, do you have some of that exposure with your trades?
So that's a good question. And just to follow up on your RSP versus SPY, I just pulled it up just to see visually that performance period. So we have RSP versus SPY here. There has been pretty good periods of outperformance for RSP, but it actually makes a lot of intuitive sense. Like, okay, so RSP versus SPY, for the listeners who are unfamiliar with what we're talking about. So the SPY just reflects the S&P 500, but it weights them based on the size of the company. So if Nvidia is huge, then Nvidia, I believe it's like 8 or 9%. Is that right? Of SPY is Nvidia.
Very large.
So there's 500 companies in the S&P 500, and yet Nvidia takes up almost 1/10. So what we do with RSP, what RSP actually reflects is Nvidia gets no more special treatment than Delta Airlines or Eli Lilly. They all get equally weighted. And so what we're talking about here is the S&P 500 typically in the last 10, 15 years has actually outperformed the equal weighted. So the biggest companies have actually gotten bigger faster than the rest of the S&P 500. Right. Basically, the big ones just keep eating everybody else's lunch and gets bigger and bigger and bigger. Whereas there also has been a period where you can see during the 2003 to 2015, you actually had the equal weight RSP outperform. So that's saying that the average company did, just having equally weighted across all the S&P 500 stocks, actually outperformed just holding the concentrated ones. So I think right here, Chris, we've had like this 2015 to 2025, that 10-year period has been a very, very strong bull market period. And so what's happened is this consolidation, these mergers, acquisitions, these purchases, these kind of pseudo monopolies getting built has created these really strong ones at the top that have outperformed. So the question is, if you go into a rockier period, could you see this happen again? And to isolate this conversation, let's take a look at 2008. I'm not saying we're necessarily going to see a 2008, but look at what happens here. 2007 comes along, and when the market tanks, RSP SPY, you can see has an interesting little move where RSP actually versus SPY gets hit hard and then kind of recovers and has a really strong outperformance period. So that's actually exactly opposite of what I would have guessed, Chris. I would have thought that during the tech or the 2008, real sharp drops, that the average stock would have been better off than the really big ones who had taken lion's share. But you also have this giant spike also here. This is a monthly candle. So just wanted to add some context. And then just to finish on your question about financials for me. So if I look at financials here, financials to me are kind of always like, they're like the most correlated to the overall market to an extent, because they are sort of the liquidity providers to the whole stock market, right? So like, I think that the call for financials continuing to be strong makes sense, because what forward vision do we have? Well, the Fed is probably going to keep cutting interest rates. The economy seems to be holding up. You have a administration that seems to want to pump the economy and spend a bunch of money. So that means getting money flooded into the system. How do they do that? Well, they do it through loans, through banks. So I feel like that's it makes sense. But I think it also just heavily depends on kind of the house of cards continuing to look good, right? You have to have the economy hold up. You have to have interest rates steadily come down, and that's been a tricky trade, right? Take a look at the 10-year yield. I mean, we've talked about this many times. We've been fighting this concept of Fed's been cutting interest rates, then 10-year really hadn't budged that much.
Right. I was looking at individual stocks. So XLF is the financial sector. And trading at 55 and change, the dividend at 1.29. It's kind of sad having a collection of investment banks look at BAC. Now, granted, individual stocks are going to be far more volatile, but you have almost a 7% dividend on Bank of America. Like, that's embarrassing that you have a money market instrument or a CD that's like maybe 3+% right now. A risk-free rate that is, I mean, obviously this isn't risk-free to own a bank if there's any solvency issues, but I think I'm going to do some deep diving here. It'll be like, let's find out if we have like 4 to 6% yields, will these be treated like dividends? Is this a lower beta? Like, this is a 0.21. So if anything bad were to happen to the S&P, I mean, only a fraction of that would be reflected in the banks, unless of course we have some type of solvency issue, right? If there's a liquidity crunch or credit crunch, then yes, banks will feel it.
I was going to say your tail end risk. Your tail end risk is the reminder that Bank of America just got back to its pre-2008 highs. Like, it dropped 90. Ready for this? Yeah, this is crazy. Watch this.
Well, I mean, I traded through Citigroup back in the Great Financial Crisis. Talk about holding that thing for a while.
That's crazy. Yeah. So obviously everything has risk, though. You can always kind of point to like, hey, here's the black swan that killed this one. Here's the black swan that
took 18 years on Bank of America.
Wow.
What is this, a Nikkei?
Yeah, right.
Crazy.
So it just goes to show, that where there's reward, there's always risk. There's never really a totally free lunch in markets. We know that. Chris,
I'm counting 95% on that, by the way. Discount. I wouldn't say discount. I'd say like, oh my gosh, my position is absolutely trash. Like, it's hard to hang on to something that's 95% down.
Yeah, it's easy to say like now, like, oh yeah, but you're a couple percentage points there from complete insolvency, complete bankruptcy.
I mean, it was, dude. It was a bailout. I mean, it was insolvency.
Yeah,
it's like these banks were saved, and so the argument is like, well, we should have not saved the banks. True, we probably shouldn't have, because then we wouldn't have this manipulated, like, never have a recession feeling post 2008. But that is now like the markets that we have. It's like there's essentially backstops for everything. The problem is you can't do it with $700 billion anymore. Now a bailout, now a backstop is trillions of dollars.
Mhm.
Let's spin it positive for a second here. I do think in the first half of 2026, look, we're going to hit earnings season here pretty hard in the next couple of weeks. We'll start with financials, see how that looks. As long as they kind of lead with a forward guidance that looks pretty optimistic, that's great. And then we have big tech. So once they're kind of showing like, hey, look, earnings are still what they say they are. We're still beating our top and bottom estimates. Then you get into Q1, Q2. It's like tax season around. If I'm not mistaken, I don't know if this is officially approved, but I think military is getting like a $1,776 check sent. I think certain households that qualify are getting, up to a couple $1,000s in check. Again, I don't love the fact that this sounds like a 2021, 2022 playbook all over again, or I guess 2020, 2021 playbook, which was inflationary. But at the same token, like the economy says, like this would be like from Scott Besson, but the economy does want to have inflation. The Feds talk about this 2% inflation target. We probably need to run hotter at like the 2.5 to 3.5%. I know our headline CPI was 2.7. I don't know what the government wants to see, but I do know that if you give household checks, if you get individuals checks, I would be confident to say that about 10 to 15% of that is going to end up in the markets. So
Easily,
we have liquidity that is going to be added into the markets. We have tax breaks that will be coming in for Q1, Q2 for households and most likely businesses. So there will be like positive liquidity events in these first like let's say 4 to 6 months of 2026, which almost tells me that unless we have a quick correction in 2026, I think that the pain trade, and you and I mentioned this a lot the last few months, the pain trade continues to be to the upside. And speaking of pain trade, what do you have there handy on the Edge Finder for AAII sentiment? Have the bears flipped back into a 40+ percenter?
Let's check it out. Yep. So if I go under our crowd sentiment, yeah, I haven't checked this. Okay, so we got a little bit more neutral here. Yeah, we've got 37.4% bulls, 34.8% bears. Yeah, kind of mixed. I mean, actually, that surprised me. We went more bullish, and then we dropped back down here a few points in terms of overall bearishness.
Yeah, so just historically speaking, the bears are about 3 to 4% higher than normal. Bulls are about the same, and the neutral camp is slightly down. So the bears, I mean, it's much closer to what we've seen historically than what we looked at a lot of 2025, which was, I cannot believe how bearish the sentiment still reads. And then it took a heavy flip there in December. Anyway, we'll see. So that was just my point of the wall of worry stuff, is climbing that while people are still overly pessimistic.
Yeah. Chris, here's another real interesting one. So we know during this time of year, there is a lot of people who do, like, there's some tax stuff that goes on with the financial markets. Like, I think a large reason you have Santa Claus rally, like that trend makes sense from a couple perspectives. Like, you can explain it. Point is, the stock market tends to go up during this period of time on low volume. We don't see a lot of buying or selling. We see a lot of people who may just want to wait until the calendar flips to lock in those gains as a tax intelligent thing to do. But there's also one other thing that we haven't talked about yet, that's a January effect thing that I'm curious about. So during this time of year, some people will make the decision to bank their losses, right? So that they have the tax loss harvesting effect, where people will, let's say you have like, here's a stock I did terrible with this year, like Lululemon, right? So let's just say that you bought Lululemon, I don't know, the summer of 2025, and you're down on the position, and you decide, okay, I'm just going to lock this in and I'll buy it back in January, right? Because I'm going to lock in so I can, bank that as a loss in my portfolio, and it can help to offset some of my gains, etc. A lot of people are sitting on a lot of gains this year due to the market going up so much, or post-April. Not everybody, but you have people who partook in the rally. So do you think there's any that stand out to you, Chris, in terms of like beaten down stocks? Do you play that at all? Like, do you watch that sort of thing? I remember one last year that was kind of interesting to follow. It's now no longer on the exchange here. But Walgreens, I watched this one last year. I thought it was interesting. It got beaten down. It got destroyed in 2024. But then it had this really interesting, like right at the calendar year, watch this, right there in the first couple trading days, it had a blast off here. It was almost like a ton of tax loss harvesting took place in the stock pop. There was also news, but generally, just thought that was funny or interesting. Is there anything that you give credence to on that side of things?
Well, I mean, I would always say that that's the I don't know if it was, I think Buffett was the one that said it, but it was like the cigar butts, right? Where it's like the stocks that, here's my question, when stocks go all the way down and they're down, 70%, 80%, if the broader market is up, and yes, I know we're concentrated in individual stocks that have done very, very well, and certain themes and narratives and stories have done very well, but I don't love the idea. I mean, it's always great to cheer on a comeback story, but it's like if we have a broader bull market where everything is up and you're in a stock that is the exact opposite, I just call that dead capital. I don't like to sit in positions and just kind of have cash tied into, a stock that maybe has no chance of returning or getting back up. Now, to be fair, it's like, Carvana. Post COVID, Carvana was absolutely at 90+% discount or something like that. And it's been one of the crazier rallies in the last couple of years. I mean, here is a weekly chart. Carvana is up to $441, up to some fresh all-time highs. And it was down from this crazy run through COVID, by the way. COVID was a 1,500% rally, 1,500% rally, down 90. I mean, it's like, I guess 99%. And then it came back and now it's back up, 2,000%. So 10,000%, dude. I mean,
crazy.
So for the one Carvana, there's probably hundreds and hundreds of absolute dumpster fires that will never, ever, ever do anything like that. So I caution everybody, like, that could be the needle in the haystack that does survive. And I mean, if you ride this thing out for 5 years, you had, 10 times your money, you gave it all back, and now you're up apparently 100 times your money. I don't think many traders are, cut from the cloth where that's going to be how they ride a stock for 5 years.
No.
So it's hard to say like, oh yeah, we just rode through it and hung on to a Carvana was great. It's like nobody knew. So point is, there is a bit of, it's hard to say like what to do with the stock like that, other than I know what I did. And when Carvana was down here at these lows, this is a 2020 low, I didn't trade it. But when we came back down to COVID lows, I was trading it in here on a measured move. So this was a head and shoulders pattern. And when it broke and went to symmetry, I cut my profits. Like I took a trade in here. It was a nice trade. I was totally happy. And yes, has it done a lot better? Yes. But it's like my trading Carvana, it's over.
Sure.
So that's it. If I see something structurally, like somebody, I saw something posted a couple weeks ago on PayPal, technically is PayPal after being all the way up here towards 309, maybe in the crypto space, if it looks a little bit cleaner, but perhaps you could argue like this is in, some type of just consolidation period. And if this is accumulation, then this would be building. If we start to break up above, let's say $100, then take this high, take this low, drag some fibs. Let's say we get to equilibrium. Well, we're talking about PayPal from currently around $60 to $180 to $200. That's a huge gain. But do I want to sit for another 12 to 24 months until that happens? Or let's say it gets worse? Not really. So I kind of, that would blanket the look of a chart like PayPal across any stock I see this way. It's hard for me to justify anything outside of a calculated risk. Like, all right, dude, I'll throw, maybe $500 at it, see what happens. If you can make 2, 3, 4 times your money, okay, cool. But it's like, it's not worth taking a big risk.
Yeah. And it's just your style. I mean, it depends what your style is what I mean. Yep. Because, not everybody is, the value person. I've actually had in my trading career, I've had way more success following winners than trying to fish out the value. And granted, we've also been in an environment that has rewarded winners over and over and over and punished anyone who is not the winner. Despite that, Warren Buffett's done really well. I mean, super impressive. But value, when you're, for listeners, whether you are trading or investing in cryptos, stocks, gold, silver, whatever, it's sort of counterintuitive when you first think, like when I first got into markets, my thought process is I want to buy the most beaten down stocks because they're going to come back. And it's a logical thought. You're like, okay, well, let me go bargain hunting, let me shop for. But what you find is a lot of times in markets, what is on sale for a reason and keeps being on sale. And it's very, the S&P 500 is so difficult to outperform because the strategy is dang good. What it does is it rotates in winners and kicks out losers over and over and over, and lets the winners get huge over time, and it lets the losers fall off the bench. So it's a good strategy. The S&P 500 is a good strategy. I think there is, if for people who are, you know, crazy enough to spend all their time doing this stuff, you can find ways to carve out, you know, outperformance, because there's massive risk too in just buy and hold that people don't know anything about until they have a huge down period. But you know, that strategy, the thought process of the S&P 500 to me actually makes a lot of sense in you know, applying that mentality to markets, which is let winners build and, you know, cut the losers quickly. So yeah. So anyways, Chris, what do you think about metals? We have some people asking about metals in the do you think, so if you had to give a general forecast, and of course things can always shape shift with time, do you think 2026 is another blockbuster year, which would be, I think, the third year in a row where we have gold and silver wide awake and just running the show? Do you think they have more of a sideways market, or do you think they have a reset year? If you had to pick one direction out of the three, what would you say?
Man, they have had no stopping at all. Even from, I don't even know what you call this pullback other than like a hiccup. Getting up to, you know, nearly 600 bars on gold. If there's pure technicals, and look, I'm saying this from like a gold and silver bull, consolidation is probably what to expect. Okay. It's hard for me to want to put in like a core position size at these highs. So I'm going to have to wait for some type of structure to show up, whether it's, you know, gold. Let's say that we do rally a little bit higher in gold, right? We rally a little bit higher. We come back in here. Now I can start saying, okay, at least area one. And if we consolidate, you know, you can add multiple levels in here. You can also position for a breakout. I mean, you can justify a trading story at a support level and also a breakout level, and then we're going off to new highs. But my concern is that we're so far away from this 200 moving average, is that something, I don't know, something dramatically happens where everyone thinks this is a great trade until they're dealt with, like, or they deal with, you know, 30 to 40 to 50% volatility, where I'm talking pullbacks. Like, again, this isn't the SPY. This is, it's like commodities can have the biggest runs and then they just absolutely V top. It's a different look than a V bottom in stocks. So I would say, you know, as fun as it is to watch this thing make highs every single day, and look, I'm in. Like, I mean, I got in on these pullbacks on gold and silver. I've started my allocation again, but I'm not nearly to the position size that I want to be, and I'm not going to build that position size where we are currently sitting. Therefore, I think they're great trades. I think, you know, now everyone is paying attention to gold and silver, which to me makes it a little bit less interesting. That's why I want to wait for some structure, because if you're participating, great. Like a run higher by, I mean, let's just throw a number out there. Let's say gold hits 5,000 an ounce. Let's say silver hits $100 an ounce. Those are amazing runs. Is it time to take profit? I mean, maybe time to pull off some percentages. If you have, this is where I would say, this is my strategy. If I'm going to allocate 10% of my portfolio to gold and 10%, whatever your combination is, let's say it's 10% total is gold and silver. Well, if it's trading at 12, 13, 14%, trim that back, keep your 10% exposure, and keep paying attention to it. But to go, I mean, I know one macro that's talking 30% gold, not silver, just 30% gold. It's like, that's a lot of volatility for what I think could be dealing with like 30 to 40% pullbacks here.
Yeah, and yeah,
that's
30% in anything. Like if you assume like, oh, that's gonna, what if it has a terrible year?
Right.
That could take down, you know, all the gains. Let's say tech stocks do have another great year. It could like wipe out all the gains that you make if gold is, you know, having a bad year. So funny story here for you real quick, Chris. Yesterday or the day before, went over and saw my family. I saw my sister, she's getting into investing. I have two sisters. You've met Julie, the younger one.
Yeah.
Jessica. She was showing me her portfolio in her Robinhood account. And we were talking about, I was like, because she's like, yeah, my gold's been doing really well. She bought like GLD like a year and a half ago or something. And she showed me her portfolio and it was 95% in GLD. And I was like, oh my, and
my gold's been doing pretty good. I mean, good.
She did really well. She's young, so she's still just barely getting into this stuff for the first time ever. But anyways, I just thought it was funny because she was like, do you think I should like maybe spread this out a little bit? And I was like, I personally, not financial advice to anyone here, but I was like, I think you should definitely consider 95%. Because gold, she's like, gold just never goes down, and that's the mentality. Not nothing against her.
Yeah, from that history, it's like, you've never experienced it going down. But what's funny is talk to anybody that's been in gold for 20, 30 years, and it's like they all sound super smart now, but it's like they just always had it as an allocation. They've always had a story around gold. They believe in it. They know it's a store of value. It's like maybe the world has to go back to it in some way, shape, or form. But yeah, it's like. It's the same thing when people thought, well, stocks never go down. And then there was a 2020, and then there's a 2022, and then there was a 2025. It's like, what we are conditioned for now is like, yes, we've been rewarded for buying the dip and buying some violent dips in the stock market. The challenging market in the future, and it will happen, and it'll probably happen by the end of this decade, will be we have a bottom, right? We have a bottom that makes another bottom, and then another bottom. And that's going to be where everyone that thinks, the V bottom is in, or everyone thinks it's buy the dip. It's like, well, that 10 and now that 15 or 20 and now that 30 or 40, they don't know what to do now. Now you're stuck in all of your positions. You're fully invested and you're watching the market go against you, and there's nothing to do other than wait. I would say that the stock market's not going to zero, but other than waiting this thing out, and it's like nobody is going to enjoy riding a 50% drawdown from top to bottom. Now, the reward on the way back is going to be great if it takes, 12 months to 5 years or whatever it might take. That's if you look at the 100% upside, that's encouraging, but it's the patience and the tolerance of how much risk and watching what's scary is like having a great outperformance and then watching it all go back. And I will say, like, I've recently been a part of this camp, and that was having a great 2020 and a great 2021 and not taking a ton of profits off the table and just staying in the markets. Like I'd say about 85% invested and just riding some of that momentum. And like, yes, I protected positions. Yes, I added cover calls. Yes, I had some collars, but holy crap, was 2022 a tough year to navigate when it's like the stocks individually are down 50+%, 70+%. That's a tough thing to just watch, all-time highs turn to, 15, 20% pullbacks.
Sure. Well, and think about, if we show my screen for just a second, like there's a lot of young people who they invest in cryptos, right? So like if we're looking at like Ethereum, this crowd is learning that, if you bought something in May of 2021, you're like, I'm going to buy the dip and it's going to keep going. If you bought it here, you're still sitting underwater, 5 years later. So nothing is, and then what people will do though, and it's logical, but the problem is the markets are not always logical. So it's logical to be like, well, Ethereum stinks. This thing doesn't go anywhere. And the NASDAQ is the best thing ever. And it's nobody's fault, because that's like how our brains are wired. You're like, okay, if this is what you know about markets, you only know this. And every dip, the more ballsy you are on a dip, the better you do. Then that is going to work very well until it isn't. And then to your point about, like, let's say that the NASDAQ does have, let's just say it has a terrible year in 2026. I don't think that's necessarily the case, but let's just say it happened.
Right.
When this happens, if you're somebody who has been conditioned and fully a dip buyer, which I am a dip buyer,
right?
But I think that you have to be, I've also experienced 2022 where the dip kept dipping and dipping and dipping and it stunk. So here's the deal is, okay, let's say you're that dip buyer, conditioned dip buyer, you buy here, you're sitting in, if you're conditioned fully in this market, then your history is 100% invested right there.
Right.
Like you're like, okay, every time this thing goes down, buy it, hold your breath, it's back and you've made 30% gains in a few months' time. But the problem is if you're 100%, you have nothing left here. You have nothing left here. You have nothing left here. Assuming if you're a working individual, you might have, a little bit more to put here, but your nest egg was parked up here. And so, the thinking here is that if you are an investor, if you're somebody who really doesn't want to watch markets, my personal opinion is like, okay, you could probably just do like 100% and then just keep working your day job and just add to it, and have enough knowledge about the markets to understand it can get horribly ugly in the meantime, but you have to say to yourself, I'm not going to touch it for 15, 20 years or 10, 15 years. Then you probably do okay in the long term. But if you're somebody who's actively watching markets, this is psychologically devastating to watch, your whole portfolio. If you've been watching stocks, like here's a very real story. I'll tell you one real quick from my own story. Let's just say to the investor who a lot of people got into the markets in COVID. A lot of people, got into stocks and watching the stock market go up in 2020 and 2021. We know a lot of people, just from my personal business, a lot of people got interested in my YouTube channel and our products, et cetera, right around here, because the stock market was going straight up and everybody was winning. So people got stimulus checks, they started buying the market, and then they, for multiple years, got shut out and watched their portfolios get hit. And specifically, if you bought more aggressive stocks, like if you bought your Shopify's, Spotify's, Netflix's, et cetera, you had some really ugly drawdowns in between. Well, I want to just show you real quick. I think I've told you this before, Chris, but I got started watching the stock market in like, I'm going to pull up the SP500 because this was my reference at the time. So I got really started looking at stocks in 2015. Well, in 2015, let's just say, 2015, around this time, I bought stocks. I would have seen my portfolio go up. Let's just say I bought the SPY like 59% over a 5-year stretch, which, by the way, doesn't sound very impressive in recent times, but that traditionally is actually a pretty decent return during, last 100 years or whatever. Anyways, in 2020, after all my entire career of investing, it's all I had seen, reset back to where they started.
Yeah.
So it's just an eye opener, and to think that will never happen again is just dangerous thinking. So
for sure,
what you think is never going to happen to markets somehow finds a way to happen someday.
Well, a simple lesson to take away from all that too, it's like 100% invested is very challenging because you have to be right. And if you're not right, do you have a plan to limit that loss? Do you have a plan to, protect your capital, preserve your capital, versus the, all in ups and downs? I'll ride this roller coaster out. Because what happens is when people are upside down in positions, you tend to rationalize anything that's going to support your story of how it's got to come back. And all I'm saying is, look, the market at some point in time is probably going to give us a 30, 40, 50% correction. I saw a pretty interesting chart that had a monthly, I don't know what period it was, but it was some type of monthly reversion, and it was a 60% correction that still holds a bull market structure. Like we could correct 60% of the S&P and still technically it's a bull market based on, higher lows and higher highs, even though it would wipe out years and years of gains. So, I mean, you have to remember in the back of your mind, like the markets are irrational. They can be irrational. This upside has been irrational. The downside can be irrational. The market overshoots on the upside and overshoots on the downside. And, yes, we deal with like equilibrium a lot of times. We deal with kind of market efficiency a lot of times. But the extreme highs, the extreme lows, they will make you crazy, unlike anything else. Because when you take emotions and money and put them together, it's like it is tapping into a lot of yourself that you really didn't know existed until you started investing and trading. And just remember, like, you can always have a way to get out of bad trades and just acknowledge like a loss is a loss. I mean, Nick, I feel like you do a fantastic job of just having very clean charts. You're in, here's where I'm out. And you're disciplined to do that. And also you're never fully invested. I mean, rarely at this point, I'd say a decade plus into trading, it's like, are you ever 100% invested in anything?
Never in one thing, that's for sure. But here's the thing too, Chris, just to follow up on your 100% theory there, I totally agree with you. But here's the thing. So we're talking about 100% invested is hard, because if you're 100%, I mean, if you're a buy and hold and never look at it kind of thing, that, especially on a diversified ETF like S&P 500 over a long stretch of time, buy and hold 100% in Bitcoin. Who knows what your returns are going to be in 20 years?
Right.
But S&P 500 or a global index, you're probably going to do okay. But the reality of a lot of people who actively watch the market, they get themselves in trouble because they're not 100% invested. They are like 180% invested.
Very true. Yep.
Because they don't just have a cash account where they, sit in a diversified set of stuff. They are, even if there's no quote unquote leverage, let me just give you some examples. If you're somebody, and I'm not trying to pick on anybody if you have these names, but if you have something like Bitminer, if you have something like MicroStrategy or Strategy, or you have Alti, right? These are just off the top of my head, Tesla. These are things that people are excited by. And there's a concept in markets that I would encourage you to please look up, which is the concept of beta. Chris talked about beta earlier a little bit. I don't know if they have it on here.
It should be at the top. Click down that little Yep, there it is.
It's like beta, right? So please look up beta just so that you understand what that is. I'm not calling you a beta, but you might be turned into a beta if you don't know what beta is, which is basically, okay, yes, I could buy 100 shares of Tesla, and let's say it's my full portfolio, and let's say I'm not using any margin. Okay, cool. But you still have outsized risk that you may not even realize, because the stock market might go down 10% and Tesla might go down 28%. And so, or whatever, right? So the point is, most people have no idea that they are actually 180% invested. Even if their actual account is 100% invested, it's probably much stronger than that, because the market might go down 10, 15, and you might go 30, 40, 50. So just something to think about. The most exciting names, nothing wrong with having those names. It doesn't make them good or bad. It's just the idea that they carry a lot more reward that you're excited about when you see in articles and videos and stuff, at the cost of significantly higher risk.
Agree. And I mean, the reality is people can hear this and they might act on it when they're in that situation. So, I mean, we're trying to issue this as like a friendly public service announcement. Traders that have been through that before, look, it's not fun to feel like your hands are tied, you can't do anything, or you're over leveraged. Or what is scary, and this is there's two ways to spin this. If you see the headline of trading margin is as high as it's ever been, that's true. Like, we're at like historical highs of how many people are trading on margin. So if there's a credit event or that margin, I mean, and it's not cheap. Like, people are borrowing at like 8 to 10% margin right now for a lot of brokers, and that's pretty darn high. But to be fair, as long as the margin continues to grow, that's actually a good sign. That's bullish for added liquidity. It just means like more people are participating and there's flows going into the markets. What you don't want to see is going from all-time highs and then just like this massive evaporation of margin accounts, because they're getting wiped out in one nasty downturn. And I think that's what it's so sensitive about today's market, is because we're so concentrated, because we have so much leverage. All it takes is like some pretty clean break levels to the downside, and it's like it's going to start liquidating a lot of people that are over their skis. And that will double or triple the volatility, and all of a sudden we're having this conversation. The VIX is spike up to 40 or 50 and the market's down 10-20%. Now we're having the same conversation. Nick, is this really the dip we should buy? Should we ride this thing out? Is this going to be a lower high, lower low? I mean, I think if we're lucky in 2026, we have contained pullbacks of like 10 to 15%. I just think contained, because it's going to be volatile, possibly. Best case scenario is it's going to be like a 2017, which is the market just goes higher every single month. Best case scenario is we just have the pain trade to the upside, and this market rips another 20%, and it's like face melting bullishness. It's like, you're an idiot forever calling the top. You're an idiot forever being bearish. Sure. But it ends badly at some point. It's like I don't think we can have markets that will just keep doing this. I just think that the odds are, it's like, okay, 3 years of nearly 20%. Because if we creep up near 7,000, we're gonna be like 18+% for the year. You throw in like a 1.8% dividend, you are creeping right up at 20% year to date, which wouldn't surprise me. And that's 3 back-to-back years at 20+% or close to it. If you throw in a fourth year, the odds are significantly less that you have anything close to that. And the 5-year returns and the 10-year returns historically for a century are absolute garbage.
Sure.
So it's just set those expectations where, having some dry powder is great. And I get it. Like, we say all this stuff and it may not matter until you're in a situation where it's like, hey man, I totally messed up. I'm overexposed. I used too much. We get it. I mean, traders do that. But if we could just give you a little public service announcement, it's okay not to be fully exposed. It's okay to wait things out. It's okay to be diversified. I don't know if it's like the instant gratification that a lot of people have, where you think you just get in the markets and you're getting rewarded for doing it. Like, you participate in gold and you're up 95%. That feels pretty damn good. You feel pretty smart, right?
Yeah.
You jump in the markets and you're up for 3 years at 60%. I mean, it's like, that feels pretty darn good. It's like you have this sense of like kind of invincibility. It's like, oh my God, I should have done this 10 years ago. I'm not realizing what 10 years looked like,
Yeah.
I'm good at this. Yeah, exactly.
Yeah,
I'm gonna do this full time.
Yeah.
How much do I need to do this full time?
So just two thoughts really quick on my side is when it comes to this concept of, it works until it doesn't. Look, you might hear Chris and I talking about, at some point there will be this giant market crash. I think that's different than being the perma bear that's saying that the crash is going to happen now over and over and over. I think that is very different than just acknowledging, like, we trade the markets. If you study the history of the markets, you do not have forever uptrends. You do have down markets. I do not claim to know where that is, and I know Chris doesn't either. We're not claiming like, hey, that is right around the corner, but based on history, okay, if you have 4 good years in a row, you start maybe saying, okay, markets expectations are getting high. People are margining into the markets. Okay, well, that doesn't mean today. And for me, for my style of trading, I'm a momentum trader. I'll tell you, there's a good chance I will follow this thing off of a cliff. However, I have a parachute on my back, my stop loss, right? So Chris, you mentioned that, like, I'm marking out my levels, and there are nullifying levels where I just say, I'm done with that. I gotta cut the trade. So I gotta get out of there. So momentum, that's the theory is like with momentum, with trend following, you have to also cut when there's no longer, you can't get stuck in the situation where you mentioned earlier, that same trader or investor starts to justify or find any reason to, I'm still in the trade. Now, at the same time, I do some different things that are more investing, more slow and steady, in which case I would actually say I'm a little bit more value minded. And I haven't really, quote unquote, invested in a stock for a while. I'm not the sort of dollar cost average every single month, just punch it in and buy type of person. I like to know very well what I'm investing in, and I'm a buy low, sell high type of investor. And there's been no buy low. So it's almost so simple, but it's like, I don't buy stocks for the long term unless the market looks like this. I did some shopping in April. And that's just something to think about. Is you can, but don't strategy flip is what I mean. So if you're somebody who's like, I like the S&P 500, I'm in it for the long term, but then it starts, you have a plan of like, okay, I'm going to get out if it breaks this support level. If it breaks and you're like, no, I'm in it for the long term, like you've just abandoned ship on what your plan is. Know your plan, whatever.
You can always get back in.
Yeah.
Yep. Hey man, I do have to run.
You gotta run. Yeah. Okay. Sorry, I kept you too long.
It's okay. No, it's fun. I'm just going to start my session late, but let's come back and do this a little bit next week. I know we have holiday trading next week, but we'll be on. So back at it. Thanks, Nick.
Okay. See you, Chris. Yeah, guys. So again, some words from the wise. Chris has been doing this longer than I have. I think that it is just important, whatever point is, if you have a theory about the market, the people who get hurt the most in markets who are people who are so arrogant about it, so full of themselves, so sure they know what's going to happen next, that when the market catches them off balance, they have rough days ahead. So don't let that be you. Just plan for, okay, if I'm completely wrong about my theory, what am I going to do about it? So, for example, I am still long gold. I've been really right in this case about gold, but it doesn't mean that next time I'm going to be for sure really right. Next time I might be completely wrong on my idea. Anyways, I went long gold. I've got a stop loss trailed below this prior high. We're looking really good here today. We have just been pumping through all-time highs. like it is nothing. And so for now, I remain bullish. So the trend here is still to the upside. I don't know where that ends. I'm just going to continue to ride it. So we also have gold getting a strong reading on the Edge Finder. We have a +7 bullish reading. We also at the same time have silver getting a +8. We do have NASDAQ and Russell. I do like the Russell. I just want to do quick markups on this. If I take a look at the NAS 100, so probably looking at, for me, a bullish setup if we were to break through this area here. This looks interesting to me. Or if we were to get a pullback into this 25,200, that starts to look attractive. But, you know, to be honest, I don't love this one as much as I actually really like the Russell. If I take a look at the Russell, just put on some trend filters here. I like where we're at. I would love to see if we could get some kind of just little brief pullback into this 38.2 to 50% retracement zone. Somewhere in that region looks good, where I may look to take a long. I've mentioned on the channel here a few times that I like the Russell on the long side. So it is a top setup right now, +10 score on Edge Finder. If you don't have a copy of the Edge Finder, by the way, we're doing our holiday sale till the end of the year. Don't miss out on the discounts. We're currently doing 40% off. If you would like some information on that, for stream viewers, we'll do 45% off if you send us a direct message on our website. You can see right there, 45% off sale happening now. Send a team member a message using that link. Also, if you are interested in that and you need a payment plan, they can also set that up for you too. So if you want to split up the cost of the Edge Finder or our Signals group or whatever, Chris and I do run a Signals room together. So if that's something you'd like to join, you can come join us there. Best way to do that is, again, just send us a message using that link that's just been dropped in the live stream chat or in the description down below. Or you can head over to a1trading.com and just chat with us in the bottom right hand. But speak to a member of our team. They can get you set up with a membership or with access to the Edge Finder. I did like that Chris mentioned AAII Investor Sentiment Survey, because that got me thinking here. So we have crowd sentiment a little bit more pessimistic. And that actually factors in bullish on Edge Finder scoring. So if I go top setups, we have, generally speaking, a decent outlook overall for indices. And if I take a look also, did we get some new COT data? Yes, we did. Look at this. Okay, so some buying on the Russell. Love to see that. Buying on the dollar. Some buying on the British pound, the Nikkei, the Canadian dollar. On the sell side, we had South African rand, Kiwi dollar, yen, silver, NASDAQ. Let's see, how much selling was there on the NASDAQ? So if I go, let's do, whoops, let me reset that. And then I'm going to go just NASDAQ for a second. So if I'm looking at NASDAQ, significant add in shorts, but also pretty good add in longs. But their positioning was already pretty bullish. So percentage-wise, slightly more of a bearish leaning week. So interesting little thought there, but NASDAQ a little bit of selling. So we'll see if that equates to anything. From a overall COT positioning, institutions are most long on things like gold, the Nikkei, silver, copper, which I think is really interesting, euro, platinum, and NASDAQ. And then on the bearish side, longer term positioning, they have NZD, CHF, CAD, Dow Jones, 10-year treasuries, the British pound. This is really interesting. The 10-year treasuries being kind of heavily sold is a very unique side of things. What that suggests is that, you know, if they're bearish treasuries, they're thinking yields could go higher. So maybe some worries about inflation or about the national debt and the ability to pay back. Who knows? But yields have been an interesting story. We'll talk more about that for sure in 2026. But my time is up on the show. We've got another show starting here. Don't go anywhere, because next we've got Marco's trading journey taking over the stream and discussing some of his top setups in the FX and, of course, gold, silver. He trades pretty much all the same stuff in terms of a macro and technical view. Don't go anywhere. His show is starting just after this quick break. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole
whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the stream. I'm sorry for the voice, I'm a bit sick, but we'll try to pull through this. So, end of the year, 26th of December, wrapping up the year. I have 2 trades open that I plan to keep on holding. So the first is a buy position on the Aussie against the US dollar. Got in the trade on the 19th of December, running pretty nicely, around 2.1 reward to risk. Then I have a buy position on the New Zealand dollar against the US dollar, running nicely as well at around, I think, 1.5 reward to risk. So on the watch list, I also have gold. Gold, although it's running away from me, so let's see what are we doing in terms of percentage for 2025. Let's take a look. So from January, we are up around 73%. That is pretty crazy. So we are up a pretty crazy amount on gold. I'm looking for buy setups, but I don't think I will get anything. Let me just enable the indicators. I'm usually looking for entries around the 20 MA. So I cannot chase the highs. I can't just buy right here. I have to get a pullback to the 20 MA. So far, that doesn't seem to be happening. Let's see also the top setups for gold. Bullish reading, which is nice. What about silver? Silver is bullish as well. So that's nice to see, although I do prefer gold because silver has been a massive, massive runner. Damn, and it's just continuing. So silver has exploded this year. Let's see, from the start of the year. Let's take a look. The 1st of January. Up to now, we are up 153%. That is absolutely crazy on silver. I think silver already made a massive move. I think, well, according to my backtesting, when you get plus 100% in 1 year, so let's type in plus 100% in 1 year on silver, usually the next year is break even or maybe even a bit negative, okay? So for 2026, I'm expecting a bit of bad performance on silver. I'm not looking to get in. I think this looks too impulsive, too crazy. It has gone parabolic. And when we do get a pullback, it's going to be a big one. So once we eventually get a pullback, it's going to be a drastic one, 10, 15, maybe even 20%. Because as price goes parabolic, like this, when there is a correction, it's not a nice correction, it's not a small correction, it's not just to the 20 MA, it's usually a big one that makes sense with the overall move higher. So the move up is parabolic, the correction is parabolic as well, right? So that is what I'm expecting on silver, and that is why I still prefer gold, although gold has just been running like crazy as well. So yeah, if we can get a retest of this support level, maybe retest of the previous all-time high, would be a nice entry for me to consider to get in. Will it happen? I'm not sure. I don't think so, actually. I think with this sort of momentum, with the edge finder being bullish, with the seasonality being bullish, the trend is up. Inflation is expected to rise in 2026. You have rate cuts coming for the dollar. You have Trump's big, beautiful bill producing a bunch of inflation, printing of money, Fed being dovish, Fed being under control of Trump. We don't know who the new Fed chairman will be. Let's see. Fed chair, Polymarket. Let's see. So right now we have Kevin Hassett leading the race once again. At one point you had Kevin Warsh being the number one, but looks like Hassett is back up in the top position. So we'll get more information, I think, in January. We should get more information in January, so we will see. Hassett is pretty dovish, so he's a pretty dovish candidate, and it's pretty funny that Hassett mentioned that he's not going to be under the influence of the administration, and that's when Trump came out and said that he is considering Hassett but also Warsh. So was it a sort of a threat? Was it a sort of an influence from Trump that he wants Hassett to do exactly what he says? We don't know, but Hassett is back up in the pole position. Okay, he's a dove. He will most likely cut rates. He will most likely aim to listen to Trump. Now, he's only one of the Fed members. There's 12 Fed members in total, so Trump does not have the majority. He currently has Governor Miron, I believe. So Miron is just a Trump puppet. He does whatever Trump wants, and he calls for 50 basis point cuts every single time. And then you also have maybe Hassett, who's going to be the chairman. That's 2 people. That's kind of 2 out of 10. So, or 2 out of 12. 2 out of 12. So Trump doesn't have the majority, but he does have some people in there that could influence other members to become dovish. What is priced in currently? Let's take a look. Fed Watch tool. So by the end of 2026, we should be around 300 to 325 basis point target range. So around 50, maybe 2 rate cuts of 25 basis points. That's the prediction. That is what people are currently expecting to happen. Definitely bullish for gold. Should be a bit bearish for the DXY. DXY keeps going lower, which is of course great for my NZUSD and AUSD positions. By the way, both these trades were signals in the A1 trading Discord. So if you want to join the Discord, get these signals, get trading knowledge, get a general interaction with other successful traders, you can click the link in the description of the stream, and you can use the code Marco to get a nice discount on both the A1 Discord and on the Edge Finder software as well. Okay, so if you want to join us, if you want to trade with us, get the signals. You would have already gotten a couple of pretty nice signals this year, but these are the latest, and they have been pretty good runners. So I'm kind of proud on these two for these 2 positions. DXY, going back to the DXY, yeah, I'm bearish, but I don't think we're going to hit 95. I know there's a couple of people that are aiming for 95. A couple of people in the A1 Discord, like Ballout, and I saw some other members as well. I think that's a bit of a stretch. I think that's very ambitious, very drastic. You would need a massive market catalyst for the DXY to hit 95. So I don't think that's going to happen, but a bit more downside could happen. Short-term bottom where I think the dollar holds is around, let's say, 96.5. So around this area, I think that is the support that should hold, and that DXY won't go much lower than that specific area. That is my forecast. That is my prediction. Just a second. There you can see I'm a bit sick, but we're doing the streams anyway. Some of the other things. My watch list mainly consists of gold and my 2 positions, but some of the other things I'm of course looking at is the stock market. As far as the stock market goes, we have the S&P, which is at all-time highs, so that's good to see. All-time highs, running higher. The NASDAQ hasn't been doing so well. Looks like the Santa rally is present on the stock market. Definite Santa rally from the 18th of December, and usually the seasonality pattern is that the last 2 weeks of the year you'll get the Santa rally. you'll get a bullish run in the stock market. So that is what's happening here, right? That is what we can see here. Why hasn't the same thing happened on the NASDAQ? Well, there has been a rotation from technology stocks into healthcare, energy, and the other, let's say, stocks that are still part of the S&P, but that are not part of the NASDAQ. So the artificial intelligence story has gotten a bit stale. People have gotten a bit saturated with artificial intelligence, you can say that. So they have moved their money from the NASDAQ into, let's say, the S&P. I personally am still looking for setups on the NASDAQ, still looking to get in, still looking to buy, but I'm being patient right now. I want to see all-time highs. So I would like to see, before I do anything, I would like to get a bit more clarity on the situation, get a bit more news, get maybe some confirmation who will be the Fed chair, and just in general, what is the state of the US economy, because the latest data prints we got in the US were not that reliable. So they were highly impacted by the US government shutdown. So the actual data was not as reliable as we would like. January and February, we should start getting more reliable data. The BLS, Bureau of Labor Statistics, they should give us some more concrete data, because the last CPI print that you can see, let's take a look at the inflation CPI US. Apparently CPI went down to 2.7%. But if you do some research, if you look into the number, you will see it's made up. There's very, very little actual data behind this number. It's more of a prediction than an actual number. So we need January, we need February, also for the NFP number as well, labor NFP. It came in pretty high at 128K, but it's pretty unreliable. Also, with the government shutdown, you had a lot of government jobs that made the NFP go negative in some instances, I believe. So I'm just waiting a bit, waiting for some more reliable data, waiting for the BLS to do their job a bit better, waiting to see what Trump will say, who is the next Fed chair. So maybe it's going to be Hassett. If it's Hassett, it's a pretty dovish play. Dovish play is, of course, very, very good for the US stock market. Or we go to all-time highs. So if we pierce the all-time highs, I'll be buying. I'll be looking for entries, setups, pullbacks to the 20 MA, and I'll be looking to get in. Right now, at this moment, I'm being more patient. That's kind of the conclusion. So I do want to mention the sponsor of today's video, which is going to be DNA Funded. If you guys are looking to expand your trading capital, get some funding, DNA is a great, great option. Not only is it a great option, but you get, I would say, the best price when you're looking at reliable prop firms with the code A1Live. So A1 Live gets you 25% off any DNA funded challenge. They are being ran by professionals. There's a big broker behind this company. They're using TradeLocker software for execution, which is, in my opinion, the best software to use. And you get a great competitive price. So if you apply our code A1 Live, they should be cheaper than FTMO, cheaper than the 5%ers, cheaper than the E8 markets. This is my personal two-phase funded account. Unfortunately, I'm in some drawdown. I haven't yet received the payout, but I'm trying to climb out of the drawdown. As you can see, I almost broke the maximum loss rule. 2 trades open right now, buy on the SPX, buy on the Aussie dollar. Both trades, thankfully, are running in some profit right now. So we will see how it goes. Hopefully the SPX continues going higher, because that would be great if we just continue climbing into all-time highs. I can maybe close this one for a profit. Aussie dollar, I'm long as well on my personal account. So this was my fundamental play on the personal account as well. By the way, this particular account, so the DNA Fund account, is purely traded by ChatGPT. So every day I get 2 trade signals from ChatGPT and I implement them on this particular account. And these are the results. So past phase 1, past phase 2, and now running the funded stage, trying to get a payout. Unfortunately, we got into some drawdown. If you want to get the updates, I made a series on my YouTube channel, or you can just join these live streams, and pretty much every live stream I go through the dashboard. Okay. Let me now go to the comments. Cycling Club, hello, welcome. Do you see GBP going up? We can take a look. Massive uptrend for gold, absolutely. I'm holding NZUSD. It is pretty bullish. I would agree. Ball out, Taco Marco, Merry Christmas. Merry Christmas to you as well, and to everyone else. Hope you had a great time. Hope you have nice holidays. And also Happy New Year if I don't see you, but I think I'll be streaming on Monday as well. So, Marco, on NZUSD target is 0.6. 0.6 on NZUSD. Let's take a look. Well, it could be the target. It's kind of ambitious, but it could definitely be the target because there has been a clear pivot where the RBNZ went from dovish to hawkish while the Fed is dovish. So the RBNZ is planning to hike interest rates while the Fed is planning to cut interest rates. That should be the perfect storm for NZUSD to appreciate in value. If you're going to place your take profit at 0.6, definitely don't do it right at 0.6 because it's a round number. It's a very, very round number. So humans tend to love placing orders around round numbers. So if I'm playing this and I want to take profits, I would most likely put a take profit at 598, let's say. Okay, just below 0.6, because we can just hit my level and then heavily drop. You know there's going to be a lot of orders around 0.6 and it's going to be a hectic market. So you want to be smart. You want to position yourself away from round numbers, not at round numbers. Just a tip. I was analyzing your trades. You have plenty of room to tighten stop loss. You could have higher risk rewards with also almost the same win rate. Have you ever thought about that? That's a good point. I would agree with you. Maybe my stop losses are a bit too big, but the sample size is too small. So I joined the A1 Discord a couple of months ago. I've been starting the signals again a couple of months ago. So there's only been, I think, let's take a look. Let me take a look at this. I have the trade tracker, which I can show you. Let's go to Marco's active positions. Put this in and expand this out. So this is the live trade tracker for my personal signals in the A1 Discord. You can see 2 trades open, both running some decent percentage, and this is the history. So these are all the trades I have taken. Again, the change is not really accurate because it all depends on where I put my stop loss. So this is not going to be accurate because, for example, I didn't lose minus 3.68% on Bitcoin. I lost much less because I risked 0.5% on this particular position. But from this table, I've had 14 trades already, plus the 2 active ones, so 16 positions. The sample size is too small. So for you to look at that and say your stop losses are too big, too wide, it's too small of a sample size. I would at least aim for 1 year of trades, 1 year of signals, or maybe 50 to 60 to 70 positions. That's when the law of round numbers, that's when the probabilities start playing out. So just 2 cents, but you're absolutely correct in saying that from my current signals, current positions, I could have considered a bit of a tighter stop loss and it would have worked the same. Or my winners would be far bigger. Hello, Sluggy. Merry Christmas to you as well. How did you and Nick meet each other? We met through social media. We met through YouTube. So Nick sent me an email one day. If I want to be on the live streams, of course I said yes, because it's a great opportunity, and that's basically how we met. I never met Nick in person. Hopefully that happens in the future as well, but we are a bit far away. He's in the US, I'm from Europe, but you never know. Maybe there's some sort of a conference that we can all get together in person. You guys from the streams, me, Nick, Chris Palver, James Forex, and Iwind, and all of the gang. What do you think of gold? Can you copy paste the prompt to use for ChatGPT? So I'm not gonna do it here, but go to my YouTube channel. So my YouTube channel is Marcos Trading Journey. Go to this YouTube channel, which is my YouTube channel, and you'll find a playlist with ChatGPT trade signals. In that playlist, in pretty much every single video, I go through the original prompt. So you're going to find all of the information you need there. What an amazing trade on Aussie USD. Yeah, I'm really happy about it. Definitely one of the best trades I've had in 2026 or 2025, sorry. So 25 has been a bit rough, tough. Forex has had lower volatility, but these last two positions have definitely helped to make the year a bit better. So that's usually how it happens. You only have maybe 2 or 3 months per year where you make most of your percentage. That's trading. That's what you learn quickly in Market Wizards as well. If you read Market Wizards, in my opinion, the best book on the topic of trading. So if you read Market Wizards, you would know that most traders on there say most of my percentage or 90% of my profits come from 10% of my trades. So they only have 2 to 3 months per year where they make the bulk of their profits. Hey, Marco, I would be interested to know, what is your opinion on stop losses and risk to reward? I feel like sometimes we overly tighten our stops, but where is the balance? I would always recommend having a stop loss. So always placing a stop loss in the market. Never execute the position where you don't have a clear area where you will get out. So always use a stop loss. And in my opinion, it's better for the stop to be a bit wider than too tight. In my particular example, the stop loss needs to make sense on the daily chart. So visually, it needs to make sense. You can see in this particular example, it's far below the 20 MA. 20 MA acts as dynamic support. It makes sense on the daily chart. There's a big chunk here. Compared to most of the candles in the prior price action, it makes sense. Same thing on NZD/USD. I know it may seem too big. It may seem like I could have put it like this, 2 times smaller. But from my experience trading in the last, 4 to 5 years, I learned that it's better to have a wider stop loss than a tighter stop loss. Because tight stop losses, they very often take you out by a tiny amount, and then the price flies. I also had a recent trade on Euro Swedish krona, which wasn't the signal in the A1 Discord because it's a very, very experimental position where I'm playing on seasonality. It's a seasonality play and just an experimentation for my personal account. Check this out. So the first position was a loss, but the seasonality pattern is usually after or between the 15th of December and the 1st of January every year, the Swedish krona tends to gain a lot of value. It has to do with Swedish pension funds. But look at this trade. So I sold on the 16th. I had a stop loss of 603 pips, and I almost got taken out. And the stop loss looks kind of big. Stop loss looks kind of wide. But in the end, I kept in the trade, or the stop loss kept me in the position, and I banked 1.6 reward to risk. So it may seem like my stop losses are a bit too wide, but from my personal experience from trading multiple years or being in the market for multiple years, that's the way to approach the current volatility. Can't you get your stop loss hit if you don't have one? Yeah, so Joshua made a good point. You can't get your stop loss hit if you don't have one. So that's definitely sound trading advice. Sluggy says portfolio is doing pretty good. All positions in the blue. Awesome. Congratulations. That's a nice way to end the year for sure. I'm from Slovenia. I'm so proud that we finally have a good trader from this region who is not a scammer. Well, thank you very much. And yeah, for those of you that don't know, we are neighbors. I'm in Croatia. Borut Rupnik, I hope I didn't butcher the name, is in Slovenia. So we are basically neighbors. Are you Italian? No, I'm Croatian, but it's pretty close to Italy. So I would like to be Italian, if I'm being honest. I've been procrastinating reading Market Wizards. Definitely read it. By far the best book on trading. I would not even waste my time with trading in the zone. I know everyone recommends trading in the zone, but trading in the zone is kind of like a market guru book. It's kind of like, it doesn't teach you anything about a clear trading edge. It talks about technical analysis, but it doesn't teach you a clear trading edge. It just talks about mindset mostly. And it's a perfect book that the trading gurus recommend. So for me personally, I didn't like it so much as Market Wizards. Market Wizards is the real deal. Actual traders, real traders, they tell you it's a competition. They tell you only the top 3% of competitors actually make money. They explain why it's so hard to make money in the markets. You need to have a proper trading edge, and it's a super interesting book. Gold. Robohola, hi Marco, Merry Christmas to you and everyone on the stream. Thank you very much. Merry Christmas to you as well, and to everyone on the stream. Let's see. So gold is going to be the last thing for today. My segment has run out, but let's cover gold and then we're going to wrap it up. So for gold, it looks crazy impulsive, especially the latest move. All-time highs. I actually bought some investment gold for my girlfriend. It's like a small bar like this, and it already appreciated in value. So I bought it for Christmas, but I bought it I think 10 days ago, so it's already up in value, which is awesome to see. But we're at all-time highs. It looks super impulsive. I want to get in. I want to buy. Top setups page. Gold is bullish. So gold. Bullish reading. That's great. I love the fundamentals behind it. Inflation is going to skyrocket in 2026. There's going to be rate cuts, but I do need a pullback. So my game plan is if we do pull back to the previous all-time high, get back to this support, I will be getting in with a buy limit order with a tight stop loss. Hopefully the 20 MA catches up as well, and then I can get in on the uptrend. That's my game plan. I much prefer gold to silver because I think gold doesn't look as crazy. Gold doesn't look as crazily impulsive as silver. Silver has gone parabolic. It looks like Bitcoin is going to crash. I don't want to participate in this price action. Gold still looks kind of decent, let's say. It still looks polite. So I love it, but I don't want to buy the all-time highs. I want to get in on a pullback. That's about it from me. Merry Christmas to everyone. If I don't see you next week, I wish you a great new year, but I do think I'm going to stream next week on Monday. Take care in the markets. Gold is my top thing that I'm watching right now. I want to get in on a buy setup. Good luck, and I'll see you in the next video.
Thank you for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want to get put on the nice list this year? Then make sure you check out the A1 Stock Box. That's all for today, everyone. We'll see you tomorrow. Ho, 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 ho.